Never become rich by investing in the stock market. I'll repeat that again. You can never become rich by investing in the stock market without accounting for inflation. This is part 2 of the 3-part video series of investing in ELSS/mutual funds. In part 1, we discussed 2 important concepts for selecting mutual funds for short term and long term, using an interesting analogy of cricket. Checking consistency of past performance to understand the probability of generating similar returns in the future, and why index funds are often considered by investors for long-term wealth creation. In this video, you will realize how ignorance of this shocking reality about inflation dooms you to a life of financial mediocrity, and why inflation is a way bigger problem than you imagine, and how it is destroying the life of ordinary people like you and me. Why it is important to start our investment journey at an earlier age, and most importantly, how you can defeat this villain to preserve or perhaps maximize the returns from your mutual fund investments. What we are really trying to understand is the actual returns of the investments after accounting for all the deductions. People, you are only told the good things about wealth creation by investing in the stock market. Promises like making 1 crore in 10 years, 10 crore in 30 years by using simple SIP strategy, the power of compounding, a magic wealth creation formula for getting 20 plus AGR returns, all of which is not true. Partially. As an intelligent investor, it's important to also understand the real returns of these investments after accounting for all the deductions. Let's take an example to understand this concept better. We all have the ambition of owning a house in our lifetime. A 3 BHK villa today costs somewhere around 2.5 to 3 crore if you are planning to buy in a tier 1 or tier 2 city. And let's assume you started your investment journey in the mid 20s and plan to buy a home in the next 20 or 30 years. By checking the simple SIP calculator, I was convinced that wealth creation is not a big deal after all. I just need patience, and if I stay committed to a SIP plan, then the power of compounding will help me reach the goal in 20 or 30 years. Well, not really. Because not only our wealth has compounded over the years, but also the effect of inflation. Like how compounding is referred to as the 8th wonder of the world, inflation is often portrayed as the wealth slayer or the wealth destroyer. Before we meet the final boss, we need to tackle 2 more barriers, and those are expense ratio of a mutual fund and tax deductions on long-term capital gains. We'll start with a simple estimation and increase complexity as we include additional factors into our model. So what you see is the simple replica of the GROWW SIP calculator. If you input these 3 values, the monthly SIP, which is 25,000, and the expected rate of return per annum is 12.5% for Nifty 50, and the holding duration of the fund as 30 years, you can get a corpus of almost 10 crore at the end of 30 years. So you have actually reached your goal of reaching 10 crores during your desired duration. But the main problem with this SIP calculator is that it does not consider the expense ratio of the fund, and it does not consider the tracking error, and no long-term capital gain tax on the returns, and no inflation rate. What we can see here is the cost of the villa today, which is considered as 3 crore, is same as the inflation adjusted cost after 30 years, which is quite meaningless. So the inflation is not having any effect over 30 years. Let's consider a Nifty 50 fund which is having the highest asset under management in the category, which is the UTI Nifty 50 fund. Let's keep all the parameters same, the monthly SIP and the expected rate of return, and let's input values one by one. Here the tracking error is 0.05% as per the latest information, and the expense ratio is 0.21%. By just inputting these 2 parameters, we can see the actual returns has reduced from 9.8 crore to 9.3 crore, and we have a difference of profit of almost 5.67%. Let's continue to input the long-term capital gain tax, which is fixed at 10%. Now we can see a significant reduction in our actual returns from 9.8 crore in the actual case to 8.3 crore, and now we have a difference of 15%. Let's input the main parameter, which is the inflation. Here we'll consider a value of 5.5%, which is the average value taken over the past decade. So what you can see is the inflation brings with a factor of 5. So the cost of the villa you wanted to purchase 30 years later has increased from 3 crore to 15 crore. That is the reason you are ending up with a cash deficit of 6.5 crore. Or in other words, you can say the inflation adjusted returns, which is purchasing power of the money, has reduced from 8.3 crore to
1.6 crore. But still what you need to understand is that the actual returns we get in hand is still 8.3 crore. But due to the effect of inflation, it has got a division factor of 5 for a rate of 5.5 percentage, and the final purchasing power of the money has reduced drastically and it is valued at 1.6 crore instead of 8.3 crore. Let's consider a fund which is having a lower expense ratio, which is the Navi Nifty 50 fund. Let's again consider the same monthly SIP of 25,000. Best tracking error and expense ratio record in this Nifty 50 category. By giving the same parameters for inflation and the long-term capital gain tax, our situation has slightly improved from a cash deficit of 6.5 crore to 6.2 crore, but it is not a significant difference. So the real problem with this is that even after investing for 30 years, due to the effect of inflation, we are still in a cash deficit of 6.2 crore. Okay, let's try to invest in a fund which can give higher returns, like investing in a larger portion of the Nifty total market universe, which is the Zerodha Large Mid Cap 250 ELSS fund. It has an expected return per annum of 15%, which is 2.5% higher than Nifty 50. And let's input the same monthly SIP value of 25,000. We got a significant difference here, but still we are in red. And the cash deficit has improved from 6.2 crore to 24 lakhs. So now you can imagine the effect of inflation, which is very significant here. Even after investing in a fund which can give higher returns, we are still in a cash deficit and we are not able to meet our goal of buying a property after 30 years.
So the situation looks really bad. But do not worry, we are only going to get better from here. Let's introduce more parameters to our system. First, increasing the invested amount. There are three options. We kept SIP amount constant for the entire duration, which is not practical. As your salary gets increased annually every year, we can also increase our SIP amount. So let's implement a annual step up SIP plan. Next is increasing your SIP amount. You can either choose to invest more of your salary, which means cutting down on your expenditures. So fewer cinema experiences than before, saying no to friends and colleagues for party and fun, cooking your own food, and compromising on yearly vacation trip and so on. Essentially, you will be following a frugal lifestyle and it's a sacrifice that not everyone is willing to take. Or the best thing you can do is to increase your earnings, that is your active income. This is very much practical and you can do this in many ways. Either you can improve your performance and ask for a pay rise in your present company or find alternate ways to generate additional income. It could be monetizing a YouTube channel through affiliate marketing in Instagram or any social media or any form of content creation for a business that you understand to grow their profit or revenue, which could be through writing blogs, designing images or posters, video editing, and creating a website. These are referred using fancy names such as digital marketing, copywriting, and freelancing. The next is trading in the stock market. Based on your active time and effort, you could do basic swing trades to advanced F1O trading. We'll discuss all these options in the upcoming videos. The next is option for lump sum investment. We will design a framework to actively invest in the market along with passive SIP strategy. That is buy the dip strategy by investing a lump sum amount when the market falls by certain percentage. The next thing is your holding duration. There is no other option than starting at an younger age. I started at 24 during the COVID time, but I would suggest to start at an younger age of 22 when you graduate from college. Any amount as low as 500 is also fine. Third, just hope the inflation in our economy will be stable for the next 30 years and the world will not witness any pandemic situation or World War III. But history always repeats itself and we can expect some turmoil like the dot-com bubble in 1998, housing bubble in 2008 and COVID in 2020. So you may wonder, this inflation factor is not in our control. No, we do have. In fact, each and every citizen of India has the power to decide their own fate. How? It's by choosing the right government. We can see from this graph that inflation has reduced from the levels of 10 to 12% in 2013 to under 6% in 2023 during the recent years. The present value stands at 5.1%. So whenever the inflation peaks and it crosses 10%, the ruling party of the country itself changes. Fourth, increasing the returns from your investments. There are two options. Instead of investing in Nifty 50, You could consider a broader market index to get both stable returns and the growth factor to get 2 to 3% of additional returns by investing in these three options. Zerodha Large Mid Cap 250 ELSS Fund or Nifty 500 Index or Nifty Total Market Index. And the next option is you can choose to actively place your SIP orders and follow certain principles to maximize the returns from your Nifty 50 Index Fund itself. We'll explore this in the part 3 of the series. Also, if you notice the calculation for the expense ratio is not accurate, we will rectify that as well. Okay, let's bring all these metrics under a single window in a Google Sheet so each parameter can be adjusted to our needs. You can find the link to the sheet in the description below. Wait, before you go, I'll explain how the sheet works, so it is easy for you to customize as per your need to get meaningful results.
What you see here is the ultimate Nifty 50 calculator for 30 years. Here we can see the page is split into two divisions. The left side calculates the option for only step up SIP, and in the right side we have SIP plus lump sum option. So the main strategy is that we'll have a SIP option running throughout the duration, and whenever the market is dipping by certain percentage, we will invest a lump sum amount. Here for this sheet we have total 9 parameters to adjust so that we can get our net returns accordingly after all the deductions, and the years is fixed to 30 years. And since this is the calculator for Nifty 50, we are actually starting to invest from 1994 all the way up to March 2024. And the Nifty 50 value at the date of SIP is considered at the last day of every month. And we are finally selling our fund at March 2024. So this is our selling year. So for the step up SIP option, we have 6 parameters to input out of 9 parameters. The first is your present income per annum. That is your net salary which you get in hand after all the deductions. Let's consider it as 1 lakh. And let's consider the contribution towards your investment, that is the contribution towards your SIP as 20%. And let's consider the same example of buying a property today which is valued at 3 crore. And we want to check our returns after 30 years and check if we are able to buy this property after 30 years. Here we are considering the example of Navi 350 fund which has expense ratio of 0.06%, and the inflation is considered to be 5.5%, which is the average value over the decade. And the final value you want to enter is the annual step up SIP. This is the increment amount you get in your salary every year, and it should be at least greater than the inflation rate. Let's consider a closer value of 6% to begin with. So what you can see is that we are ending up with the cash deficit of 4.3 crore, and it is same for both SIP and lump sum option because we are not inputted the parameters for lump sum option. So the interesting point to note here is that we are actually meeting our goal of reaching 10 crore at the end of 30 years, but due to the effect of inflation, we are having a cash deficit of 4.3 crore. Let's improve our situation from here by investing a lump sum option along with the regular SIP plan. So what you are essentially doing is that you are investing a multiple of your investment amount, that is your SIP, as lump sum whenever the market is falling by some Y%. But it is applicable for only certain number of time. That is, you are investing X times your SIP amount whenever the market is falling by Y%, but it is only applicable for Z times in a year. So let's consider investing a lump sum whenever the market is falling by 5%, and let's consider lump sum which is a multiple of SIP as 2 times, and I want to restrict the lump sum option for 2 times in a year. So we can see we have improved our cash deficit situation from 4.3 crore to 1.6 crore. This is due to the fact that our total invested amount has increased from 1.9 crore to 2.2 crore here, and we can verify that over the past 30 years Nifty has generated a CAGR of 12.5%. The problem with this is that our returns is not sufficient enough to meet the inflation rate. Let's continue with our investment in a slightly larger index, which is the Nifty 500 index. One such example is the Motilal Oswal Nifty 500 fund having the expense ratio of 0.38%. We'll keep all the parameters same. Only thing is that we are having a difference of expense ratio, and here the duration is fixed to close to 25 years instead of 30 years, because the Nifty 500 index as per NSE data is available from June 1999 to April 24. And like our previous example, we started our investment at June 99 and we are selling at the month of April. And similarly, we are considering the month end values for our SIP date. We can see that we are still ending up in a cash deficit of almost 3 crore. So the one thing we can do to improve our situation is to increase our annual income. So let's go back to our Nifty 50 sheet and let's increase our increment per year to 10%, which is much higher than our inflation rate. So now finally we can see some green numbers in our sheet and we are in a cash excess of 5.5 crore. And let's continue with our Nifty 500 sheet. Let's also input 10% here. So in the SIP plus lump sum option, we are ending up with a cash excess of 18 lakh. So change these X and Z parameters with caution, because when you are putting this value as 2, so in a month you are investing your SIP and also 2 times of your SIP, that is 3 times of your SIP in a month whenever the market is dipping by 5% here. So when your contribution towards your investment is, let's say, 25% and you are investing 3 times of your SIP during that month, it comes around to be 75,000, but your total income per month is 1 lakh. So choose these values with caution, but you are free to invest whenever the market is dipping by any percentage, like 2% or 4%. One interesting point to note is that the expense ratio is always mentioned as a percentage of total asset under management, which can be a number which is quite less than 1 or 0.5 percentage, and we don't feel the effect of this number. Instead, what we can do is that we can calculate this expense ratio as a percentage of invested capital or as a percentage of capital deployed over the entire duration we are holding the fund. Here we can see for almost 25 years of investing, we are actually giving an amount of 27 lakh to the fund, which is 9.2 percentage of the invested capital, or is equal to 2.7% of our profit from the fund. So these numbers are quite different and are somewhat high. So choose the expense ratio with caution.
Now you are fully set to plan for your future investment goals. The sheet is all yours. Okay, let's summarize the major takeaways from this realization. Passive SIP investing cannot help you reach your goal in a specific duration. You might need active participation in the market and should learn the basics of investing. Second, you need to find ways to increase your annual income by a percentage at least greater than the inflation rate, and always choose a fund with the lowest expense ratio and calculate the expense ratio fees as a percentage of your invested amount or profit. And fourth, the most important thing is consider the effect of inflation when planning to invest for your goal. Be aware that the inflation rate we considered earlier is not accurate but is an abstract representation of almost 300 plus goods and services, in which each category has a separate weightage to the total inflation, just like stocks in Nifty 50. But luckily, the data here shows the housing inflation rate is around 4%. But I am not really sure about this. If you are aware, please let us all know in the comments below. All that said, I have a good news to make you feel better. If you are using your capital gains from the mutual fund investments to purchase a residential property in India, then according to section 54F of Income Tax Act, you are eligible to get complete exemption from the 10% tax of long-term capital gains, with some additional conditions applied. You can check more about this in the description below. In the third part, we'll explore the methods to identify the dips in the market for lump sum investment by analyzing specific indicators in TradingView platform. So get ready to analyzing charts, creating patterns, and framing a strategy to actively invest in the market. If you haven't watched the part 1 of the series, click here. And if you are about to take your first step towards your financial freedom, then click here. Stay tuned for part 3. Until then.